We'll just have it as long as possible. Okay, it's recording. Okay, so that's fine. So basically, we'll just quickly go through it. I'm going to turn this off. So I'm going to stand about this close. Talk basically first slide. I'll just do all this intro. So I'll just say a quick, Mark, do you want to say a quick hello? Blah, 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 blah,
yeah,
blah.
sure.
Yep. I'm just going to talk a little bit about you. So tell me if any of this is wrong. I don't want to embarrass you too much, Mark, but for our viewers who might not know you, Mark has over 26 years of experience in the financial markets. He was actually the founding president of the Australian Securities Trader Association and was the executive director for Genesis Trading, a proprietary trading company that was built from scratch to over 100 employees in just under 2 years.
It's under, man, no, it was 5 years.
Okay, 5 years. That's cool. That's what I wanted to. And I'm just going to say, so safe to say, he's had a lot of experience in this space. Now, what, you've been with us, Mark, for just under almost 2 years?
Yeah.
Yeah, and I guess, it's been obviously a pretty volatile start to 2022. What's your views of it all been?
Essentially, obviously, the market's in pretty high panic at the moment.
Yeah, that's fine.
Yeah, right.
Yeah. So that's all.
Yeah, okay.
Start.
Yeah, no,
and I'll just kind of do slide 2 is basically just this stuff here.
Oh, right, yeah. You've obviously got to do the disclaimer. At the
Yeah,
start,
disclaimer.
right?
He told me to rewrite it, but I might just read like
when I did it, I used to just read the first few lines.
Yeah, okay. I'll just literally just do that. Yep. And then basically, let's get straight into it. What's a stop loss? I'll just define it. So obviously here, what's a stop loss? Then here, whilst it's very easy to implement on a sophisticated high-level broking platform such as Iris, or especially with an advisor, there aren't many retail brokers for self-directed investors, blah, blah, blah. Now, Mark, there are some key differences between a stop loss and a stop limit order. Could you just go into those differences a little bit for me?
So a stop loss order, it's a stop loss market.
Yeah, okay. That's fine. So that's good. As long as I'm just kind of preparing you for everything.
Yeah.
And then at the end of this webinar, in the walkthrough, we'll obviously explain it a little bit more, blah, blah. As shown in this screenshot, while placing a sell order, the client can easily place a conditional order by clicking the stop limit order at no extra cost. Only cost is brokerage, but when it's executed. 2 main advantages: Oz Minerals. I've provided one, Oz Minerals here. Mark, other than the China lockdowns, I'll talk a little bit about that. Can you provide any other reasons, or maybe just a little bit of clarification for our clients about copper? That one.
Yeah.
Next one. Now, whilst we experienced a loss of about 27% as of the 13th of July, it's trading below, so that's fine. I'm just talking there. Now, a loss causes a profit. That way, macro dynamic in nature sector, it updates the stop loss and target price, whilst the client can adjust the orders as a result. And then non-entertainment, I'm just going to go through all of this here. As you can see in the graph, stop loss, was actually an adjusted, profit take, pretty much all there. The next time I'm just going to ask you is I'm going to talk the whole time about this one, and then we're just going into it. So sell Pabara, kind of just outlook on lithium. Next one. So I'm just going to say interesting one, Mark, because it was one of the best performance throughout 2021, but it's one of actually the weakest since 2022. Can you provide, obviously there's been the Goldman report, but blah, blah, blah. And then obviously we're rebuying it at a lower entry price. Number 2 is selling Aristocrat, just kind of saying, Mark, what was this one here? Aristocrat. Oh yeah, I'm just saying pretty much all about Aristocrat. Don't really need your input there. I can say once again, Mark, place the stop loss. Yeah, and then Elders. I was just going to say, can you provide a bit more insight into some of the fundamentals? And then Nick Scully, this one I'll probably obviously just say something like, Mark, obviously, this was actually one of your recommendations. It's got very strong fundamentals. Obviously, great technically great over the last couple of years. Can you provide a bit of insight as to why? And then obviously I'll just say, how much it's actually fucking saved us. Bloody saved us.
Yeah.
GQ, did you look much into GQG?
Not really. It's an active fund manager, which is fine. They've got a good track record through periods like this. Yeah. Similar to this is on WAM.
Yeah, so, and then it's already paid 1.5% as a dividend, but I'll say that already. It's paid 2. It has paid 2 since the start, but it paid 1 February and 1 March. Yeah, both at 1.5%.
Yeah. Okay.
So I'll just say that in there. Obviously, you can leverage, and that's it.
Yeah, sweet. That's easy, mate.
Cool. All right, let me just get everything in order again.
That's what I always found the hardest thing was trying not to make noise with the paper.
Yeah, I actually because I'm a bit rushed. It's I probably will honestly, but I'll keep them kind of a little bit away. Hey everyone! No, I'm not doing that. All right.
No. It's a bit crusty to clean.
Yeah. Hey everyone, and welcome to our third macro minutes in our webinar series. It's good to see a mix of prospective clients, clients of the past, and current clients here today. Today in the meeting, I'll be talking about the benefits of implementing a stop loss strategy for our downside, but also how it helps to not only protect our portfolios on the downside, but also to lock in profits on the upside. Joining me today is Mark Gardner, our head of trading here at the firm. Mark, did you want to say a quick hello?
Hi everyone, welcome to the webinar.
It's really good to have you. I don't want to embarrass you too much, Mark, but for our viewers who might not know who you are, I just want to introduce you a little bit. Mark here has actually had over 26 years experience in the financial markets, and he was actually the founding president of the Australian Securities Traders Association and was the executive director for Genesis Trading. It was a prop trader company, which was actually built from scratch to over 100 employees in just under 5 years or so, Mark?
Thereabouts, yeah.
Yeah, so it's safe to say you've had a lot of experience in this space, and you've been with us at Maqro for what, just under 2 years?
Yeah, around about then, yeah.
And look, whilst we're on this topic of equities, it's obviously been a very volatile start, very different to when you started in 2021. For 2022, what's kind of your overview been?
Look, obviously at the moment we're fairly under pressure on a very limited amount of data overall. Key inflation data and, very much the biggest economy in the world being the US and the second biggest being China, basically in two very different cycles. So it's made for a lot of investor uncertainty, and I think things will start to calm down through the US and Aussie earnings seasons as some more data comes through, and we get a little bit more of a little bit more clarity on the China reopening and US inflation. Yeah. Now, moving on into the actual webinar, we actually have a really exciting schedule for today. So firstly, I'll quickly detail what exactly is a stop loss, the advantages of implementing that strategy, and then explain how our dynamic stop losses work in practice as a macro client, showing how our model portfolios help to not only minimize the loss on the downside, but also to lock in profits on the upside as well. Secondly, Mark and I will explore some of the positions in our model portfolios that have hit the stop loss over the last 3 months, and also the rationale behind those. But more importantly, we'll actually go into the strategies with the resulting cash. And as we rotate into those stronger fundamental companies, hopefully that will look to outperform within this current macroeconomic cycle of higher inflation and higher interest rates. And then finally, to show our clients exactly what you receive, at Maqro as a client, our managing director will actually providing you a walkthrough or a product demonstration of our research portal. So that's where all of our recommendations are placed. You're able to view all of our model portfolios, and we'll also go into the discounted trading platform or the discounted brokerage there and explore exactly why and how you get access to all of that. And then as well, for those who are interested in becoming a client, it is a good time with the new financial year, of course, as well. We'll also have some very discounted product offerings at the end. Me and Mark will probably answer a couple of questions that you have along the way as well. Now, as always, this information summarized does not constitute financial or other professional advice and should be taken purely as general in nature. It does not take into account your specific circumstances and should not be acted on without full understanding of your current situation and future goals and objectives by a fully qualified financial advisor. Let's just get straight into it. What exactly is a stop loss? So a stop loss is a conditional order to sell a specific stock whilst it reaches a certain price. Now, on the downside, of course, it's designed to limit the loss of the position that we already have in a portfolio. Now, whilst it's actually very easy to implement on a very sophisticated or a high-level broking platform such as Iris or with a qualified advisor, there aren't many retail brokers for self-directed investors that actually have the ability to place these for their holdings. Just as one example, CommSec doesn't actually allow conditional orders
without further paying for a subscription, on top of their already elevated brokerage of $20 to $30 on average as well. Now, Mark, before I kind of move on forward, there are some key differences that I want to make very clear between a stop loss and a stop limit order. Would you be able to just go into that kind of difference a little bit for me?
Yeah, so stop loss, it's a market stop loss, which can be quite dangerous with these gap opens sometimes in the mornings if the markets are liquid. So basically, if it trades through a price, it will just sell at market, no matter what the price is on the bid side.
Okay.
So, you obviously, there is some dangers there, but you are guaranteed to get out. Whereas a stop limit, so for instance, you're selling and we want to sell at $1 on stop. Obviously, a stop limit means that it will go on the offer at $1. So you do run the risk that if it gaps through $1, that you might just be left hanging on the offer side there. So you do have to make sure that you're still sort of checking your orders, which is a good habit to get into anyway when you're operating your own self-directed system. So yeah, it basically just won't go to market for you. So look, there's upsides and downsides to it all. Very few platforms, if any, will get guaranteed stop losses. So
yeah.
You need to basically choose what's right for you. And obviously, if you made the choice to be self-directed, then you obviously need to be diligent with your order management. So
now on Maqro's platform, whilst, as Mark correctly pointed out, we do actually have a stop limit order. So it's probably still, whilst it's maybe not as sophisticated as a stop loss, it would definitely still help on the downside, wouldn't it, Mark?
Oh, absolutely, yeah.
Yeah. So as you can see, whilst placing a sell order on Maqro trade, our clients are easily able to place, this conditional order. It's actually at no extra cost either. So whilst it gives your clients the ability to further protect their portfolio on that downside, even through the stop limit order, it does actually cost nothing to implement. Of course, there is a brokerage cost. Now, whilst it is already market leading at, as little as $4.99 as shown here, it does tier up to a maximum of 0.1%, which is of course still extremely low. For all self-directed clients, it's only actually charged once, of course, the limit goes through or that stop loss is hit. So it doesn't actually cost anything to implement that, just obviously charged when the order does go through. We like to think of it as well as a bit of a free insurance policy. You can implement it, still be more protected than not having it on the downside, and then only pay the same brokerage cost that you were going to pay anyway when it is hit. Now, there are two major advantages or main advantages of implementing stop losses. And that strategy, the first one is cutting your losses, of course. Now, without saying any advice, there are some clients that I've spoke to that choose to hold on to positions no matter what the fluctuations are of an asset. Whether that's because there's an emotional attachment, maybe you've held it for, 1, 2, 5, 10 years, whatever it may be, or you like to hold on and just collect the dividends, doesn't matter. But there is, of course, the chance that a falling asset can continue to fall. Stop losses help to insulate your decision from taking away the emotional from it and keeping it purely as a number. So in order to maximize our model portfolio's returns and, of course, minimize the risk, the stop losses help us stay on track with this intended strategy, where it can obviously prevent further losses on the downside. Here in the screenshot, I've actually provided a past example of a closed recommendation only recently where this strategy was used. Now it is Oz Minerals, OZL. It was a position that we held in our ESG model portfolio, as initially our analysts saw a long-term bullish outlook for copper. However, with the continued lockdowns of China, which is of course the largest copper importer in the world, it did reduce the short-term demand. Now, Mark, I'll bring you in for this. Other than the China lockdowns, is there any other major reasons you can think of maybe why copper is trading? It's still around about those 16-month lows.
Yeah, look, the talk of recession, obviously, and due to rising interest rates potentially because of inflation, copper's sort of regarded as the bellwether or the canary in the mine shaft generally. When there's a turn in the cycle, so it's usually the first sort of metal that really does turn around. And look, even though we've still got chief analysts at the major banks calling sort of 30 to 40% chance of a recession, obviously that copper being one of the things that's traditionally fallen first, it's kind of the first thing that's sort of that has turned around. So Oz Minerals as well, it has a low dividend yield compared to those big miners, so only around about 1 to 1.5%. So you know, we're in a value market where, you know, you can buy Rio, which produces a lot of copper, or BHP, which produces a lot of copper and pays anywhere up to nearly a 10% fully franked dividend, versus Oz Minerals, which has a big capital expenditure and is really dependent on the economic cycle. You can understand why.
Yeah.
I mean, I've switched clients out of Oz Minerals into BHP and Rio, you know, over the last sort of month or so.
Okay.
Just for the lack of margin of safety. And look, I think it's still a good company, but obviously this thing's now trading very close to lows. I can't imagine the stock price would be, you know, you'd be regretting that decision right now.
Well,
yeah, you can always revisit it later.
And look, it's exactly that. You know, whilst this position, we saw about a 27% fall when it did hit stop loss. As of the 13th of July, the position's currently trading at 16.29, which is obviously much lower than when we hit stop loss at 17.17. Now, look, as always, past performance is not a reliable indicator of future performance, but by having that stop loss in place, our position was able to save a further 5.2% on the decline, which of course is implemented through that model portfolio, which is when we close a recommendation, of course. The other advantage here is while placing the stop loss, you know, does help to place in the profits on the upside. Very briefly, we'll go into the Oz Minerals here. You can see on the graph, the entry price is on the left. And as we saw that further decline, we saw it stop out here. Whilst we did see a broad uptrend, it has continued further down. Moving forward, as mentioned here, we can also lock in profits on the upside. Now, I know what you're thinking. How can a stop loss, you know, actually mean profit? Well, the way that Maqro utilizes the stop loss strategy is by having all of our holdings and the recommendations dynamic in nature. And so when the fundamental outlook of the company or sector changes with the market, we actually detail the research so that the target prices and stop loss are reflective of those fundamental changes. One example here is Nine Entertainment. It was a recommendation that was coming out, you know, last reporting season, funnily enough. Reporting season is obviously a time when we regularly see positions fluctuate 5, 10, or 15% at both the upside if they exceed expectations, or on the downside if they do miss. Now here at Nine, it was actually recommended because we expected stand numbers to be higher, but well, that was obviously as a result of the Delta lockdown. And however, whilst the report wasn't all that bad, it was a decent outlook. We did see stand numbers fall away, and our research team saw no further upside. What you can see, and as it's shown in the screenshot here, the stop loss is actually higher than what the indicative buy price is. And that's because we adjusted that stop loss so that we sold out of that position. I'll show you graphically. We've implemented the entry price on the left again. And as we saw that further uptrend right up to obviously this decline here, which was then when the report came out, we stopped out on the decline. Now, what you can see is that we put that stop loss at 1 cent below what the current price was. So that if there was further upside, then we would have made the profit there. However, it did continue to fall. What it did, the position locked in 5.3% return. However, once the market repriced in that report and the further outlook, you can see that decline over the next few months, and it actually fell a further 10%. So locking in that, well, adjusting that stop loss, quote unquote, to be a profit take made the position 5.3% as a result of what could have been a 10% loss. And look, that's just one example. Again, past performance is not a reliable indicator of future performance, but by remaining active with those stop losses, we're also able to lock in profits as well.
Further to that, Nine Entertainment, seasonally, it will only rally in the month leading up to reporting season and the month of.
Okay.
So there's only 4 months out of the 12 in the year over the last 10 years that stock basically rallies. So that's a discussion we've had in the office about that. Was why that one we were very tight on that stop. I think when I was doing the active recommendations, was one of the reasons for elevating the stop is because we had that base expert knowledge.
So it's more of a reporting season play.
It's much more of a reporting season play, whereas you may not be raising that stop on your long-term holdings, but that one specifically is a great example there. Like that's where it really helps you out in a specific circumstance.
Okay, and then look, the last point I'll make on this is an example that you will get as a client of the firm. Now, what I mean is that I want to show you exactly how the recommendations are not only adjusted, but communicated to you. Once you come on board, the development team places you on our automated SMS and email notifications so that you're made instantly aware of any entries, price target adjustments, stop loss adjustments, and then of course the exit. So when they do hit, whether they're adjusted or not, you're notified straight away. As the example, it was a small cap name, Grange Resources, GRR. It was actually recommended for the small caps division at initially a share price of 58 cents back in November of 2021. Now, initially it had a price target of 79 cents and a stop loss of 41 cents. Now, whilst holding, the outlook of the iron ore price brightened over the next 2 months, mainly as a result of the global coming out of the Delta lockdowns. And so we actually updated the price target from 79 cents to 83 cents on the 4th of January this year. In that time, Grange Resources announced a special dividend of about 10 cents. I think at the time it was about a 12% dividend yield as a special. And that was as a result of a large cash position that they had, which they redistributed to their clients. Again, we updated the price target here, which was communicated through our emails. This one's on the left, where we created a new indicative target price of 83 cents. Also, of course, it's posted onto the portal, but just 1 week later, we also adjusted the stop loss up to 79 cents when the price was about 81 cents, due to that strong momentum of both the iron ore price and then the general technical uptrend of Grange Resources as well. Why I bring it up is because it actually didn't go further onto that new indicative target price shown on the right of 91 cents and actually stopped out, again, quote unquote, stopped out at 79 cents. The reason why I bring it up is because once again, we actually remained active with our stop losses. And we not only adjusted them on the downside, which we showed previously with Oz Minerals, but also on the upside. And what that actually meant was that the model portfolio, or this position within the model portfolio, returned 36.1% in growth, or if you include the franked dividends, 60.8% for a 2-month hold. Now, again, past performance, it's not reliable for future performance. It shouldn't be a reliable indicator. But those active positions that our research team does, which we communicate directly and instantly to all of our clients, is a great example of this. Now, moving on to the second half of the webinar, Mark and I will detail some of the positions in the model portfolio that unfortunately we have stopped out on over the last 3 months or so. Variety of reasons, volatile 2022, fundamental change in outlook. But look, we'll go into some of those. And then more importantly, the strategy that we've done post with the result of the freed up cash and putting that opportunity cost to a better use. First position that hit our stop loss was Pilbara Minerals. Mark, it's an interesting one. It was actually one of the best performers in 2021, but it's been one of the weakest in the top 200. Obviously, the extremely hawkish Goldman report on lithium and rare earths in general, it was a major contributor, a lot of it falling 20, 25% on the day. But do you think that was a bit of an overreaction? What's your kind of outlook on why maybe this position hit stop loss?
Oh, look, it was disciplined to stop out on it. We're still sort of lingering around at those lows at the moment. I think reporting season will probably iron this one out. Their quarterly updates have been quite extraordinary. But at the moment, the market's sort of, it's a bit of a classic case of the baby being thrown out with the bathwater. Goldman's downgraded lithium, but realistically, it was more aimed at, say, explorers and people who aren't quite in production yet. These guys are in production, increasing production capacity quite a lot. But sometimes when the market's sort of surprised by something, the whole sector will get sold before the analysts get to look into the details.
Yeah.
So stuff like this, PLS, etc., and Alchem, for instance, who are producing, will probably see a rise back out first of all. Lithium not actually being a particularly rare commodity, if there is oversupply in future. Stuff that, like explorers, are much more prone to a 5-year outlook, whereas these guys are making record prices now. So, but sometimes, as I said, we had a similar situation in the REITs. The guys who had 20% debt versus the guys who were 60% debt got hit on the first day exactly the same amount as a percentage basis as index funds sold the whole sector. So look, it's
and then broadly recovered.
And then the good ones broadly recovered first. So it look, it happens in markets quite a bit. Particularly when institutions are having to really pivot for a surprise event.
And look, bringing it back to the stop losses, as you can see, we stopped out at $2.34. The lows on the day were $2.25. So it saved for about 4% for our model portfolio in the position there. And it does actually lead us on, quite interestingly. Our current strategy for it is we actually repurchased it at a lower entry price. Again, you can see $2.28, only a couple of days after we stopped out. Reason for it is we wanted to see if there was a bit of a rebound, which there did seem to be. But Mark, again, can you kind of give us a bit more of an insight, maybe this time into the technicals and why we've actually done our price target at the previous, I guess, the day before close that when it hit?
Well, it's a classic close, gap close, which is a technical. So gap downs, markets tend to try and find, tend to gravitate towards those gap closes on a rebound. It'll be a pivotal point going forward. And obviously, it can retrace to that point, and then often it'll fall away from that old high. But obviously, as you showed with the dynamic stop losses and price targets before, I think if we start to see an increase in that, in that stock back up to those levels, I would imagine, on a good report or something, we would probably revise our price targets back up to where maybe it was the existing. So that thing has traded $3.80, and they've had some fantastic results. So, but it was very sensible to wait and see, because the Goldman's report was, you don't normally get a reaction like that out of a Goldman's report. I think it was very much elevated by the level of nervousness in the market at the time. So,
and it was actually where on the day of the report, of the Goldman report, it didn't have too much of effect in the Australian equities, but then the next day for the US, we saw a broader sell-off, and then that would obviously caused a larger sell-off back in Australia. And maybe that is another reason why there was that overselling.
It was very much Australian based, but I think the biggest lithium miners in the world are sort of here. So here on Canada, really. So there was a bit of they're underdeveloped assets in the US, which, so it wasn't really much of a talking point. They're not big on materials over there.
And then for the second one, moving on, is a stop loss that we hit on Aristocrat Leisure. Now, ALL, generally speaking, it hit because the consumer discretionary sector has been hit fairly hard with this macroeconomic theme that's been going on. Obviously, there's been a reduction in consumer spending. And of course, in the sector of consumer discretionary, this one does get hit a bit harder. Year to date, the sector as a whole is down 20%. Once again, the stop loss was implemented to protect our clients. The model portfolio's stop loss was at $30.26. On the day, it did fall as much as $30.13. So saved about 1%, not as significant as the others, but it was more of the sector play. Mark, can you tell us a bit about Elders? We've reallocated into a more of a defensive name, maybe in nature, one that definitely for reporting season, its outlook has already been extremely strong. It's beat market expectations in all key financials and also increased its dividend. Can you just give us a bit more of an insight maybe into this one?
Yeah, and just so viewers aren't confused, this is an off-season reporting. It reports more sort of May and November.
Yeah, it's already
agriculturals. Yeah, so don't be expecting this one to do a hell of a lot in reporting season normal, which is going to be in August. But with this favourable agricultural conditions, Elders has got a bit of a checkered past, and management's been very, very strong in the last sort of 7 or 8 years. They're actually now they've tried to really buffer themselves from, well, agricultural companies traditionally have been very prone to to economic cycle, whereas these guys have been through drought, they've been through floods, bushfires, and 2 economic cycles basically over this sort of 10-year period, and they've actually managed to reduce the swing back and forth in their profitability. So they're, look, with the geopolitical situation, Elders basically, it's like an agricultural ETF in a way. They take a little clip of many transactions across the board from real estate, cattle sale yards, grain sales, and the like. So basically, if the agricultural sector in Australia is healthy due to the favourable weather conditions, which it is right now, Elders is going to be making great money. So real property prices as well. So look, and consumer staples traditionally is the things we need as opposed to the things we want. Is obviously a decent sector to be in. sort of similar in a way to healthcare. You know,
Non-cyclical in nature.
You don't want to go to the doctor, you need to go to the doctor, so you need to eat.
Does also have a bit of a financial backing, where in the rising interest rates does also have a bit of exposure there, which is beneficial.
Yeah. So look, it's until we have the El Nino weather pattern return in Australia and potential drought conditions. I mean, these guys are going to report well for 2 years. So and then you'd be maybe looking at something like the food ETF, which is more the US based, which is currently in drought, getting the El Nino. So
yeah. Now the final position we have for our clients today, Mark, is Nick Scarlett. One, unfortunately, you probably know a little too well one of your recommendations, but a very, very key level of why stop loss is extremely important. Initially, of course, well, it is in the consumer discretionary space again, but it does have extremely strong fundamentals, had pretty sustained growth over, you know, a historical period. Why has it struggled 2022?
Look, this was one where I went and looked for characteristics of a company with, you know, an impeccable track record that's founder-led. And essentially, those were the things that actually ended up working against this position. Because the top 5 shareholders are extraordinarily sticky, including the founder, and they don't do a hell of a lot on market. It's only 700 million market cap, and essentially, it's that means the daily volume is quite thin. So this company's never reported a worse result than the previous ever in its listing history, and yields 7 or 8%.
Yeah.
However, obviously the market downturn has been between when it reported last and now. And it's not one that's prone to giving too many updates overall. So this is where a stop loss would, you know, absolutely have saved your bacon. It's been down to $7. This thing, it's since recovered to about $9. One I would expect that that could really surprised to the upside on reporting season. But you know, you obviously, if you hit your stop loss and sold, where was it around?
$11.40. Just to let Mark know, when it hit, it was at $11.40. Today, it's about $8.74. So that's about 25%.
And traded a low of $7. So you've had many opportunities to get back in, and you could have had that cash on the sidelines for other opportunities.
And it's exactly right. It's not just about the potential loss that we've saved, but also what we can do with that remaining cash.
The opportunity cost, I think, is an extraordinarily underestimated part of the stop loss.
And where we've done that, or at least one of them, we've rotated into a fairly new position on the ASX, GQG Partners, more of an active position. It's actually an asset manager. You know, it does pay quarterly dividends. It's paid both around about 1 to 1.5% each. Mark, you know, does have strong revenue inflows, mainly from the fund. Can you give us, I guess, a bit of an insight why this would benefit in this period?
Look, the chief investment officer's got a fairly solid 5 or 6 year track record. They did very well over COVID, or he did very well over COVID, apparently. One of these sort of boutique fund managers in a way. And they're very good in active environments. So there's other ones that have done quite well in cycle changes, like you know, Wilson Asset Management and things like that. Some fund managers will do well in a grinding market, like perpetual or you know, value-based sort of environments. Obviously, you know, you've got the Cathy Wood arc, which is great for growth. So you almost have to, you know, it's okay being in fund managers, but you got to obviously be wary of what their investment philosophy is. These guys, active's probably not too bad at the moment, being agile. They can be maybe, you know, they're not committed to positions which may unfold poorly for them. So, and they'll probably be less likely to be vulnerable to the cycle as well, being active. So obviously the management fees are going to be a little higher, but you know, if this guy's got a good track record through turbulent times, it's not a bad place to have your money. So exactly. I can see why they've had a bit of inflows, particularly with some of the poor performance versus the market of some of the major fund managers like Magellan, etc., in the Aussie market for the last 2 or 3 years.
Well, look, that's just a brief summary of our strategies and how our model portfolios have historically outperformed on, again, both the downside, saving our client or saving the model portfolio money, and then, of course, taking the profits where, you know, that has seen further downside as well as our current positions. So where we freed up cash and reallocated into, you know, some more fundamentally strong positions for this market and this current fundamental economic outlook and beyond. However, our managing director has kindly dedicated some time to show all of our viewers the current holdings, all of the positions, and the trading account fundamentals, which is actually what you get exactly as a client once you come on board. We'll quickly cut away to the walkthrough of the platform. Conrad will take over from here.
All good. Cool. Is that all right?